When a Vermont janitor named Ronald Reed passed away in 2014, he left behind a secret $8 million fortune. He didn't inherit his wealth, and he didn't have access to exclusive Wall Street insider information. He never attended an elite institution like Harvard or earned a degree in high finance. His strategy was remarkably quiet. He spent decades saving small portions of his modest paychecks, allowing the compounding math of the stock market to work in the background. Because Reed's path required no rare intellect or special connections, it creates a dangerous illusion. It makes building wealth look like a free lunch. Think about the transaction involved in buying a luxury watch. If you want that piece on your wrist to impress your friends, you know exactly what to do. You swipe your card and pay the price tag. You accept that desirable things cost money. No rational person expects to acquire a high-end item without a clear exchange of value. Yet, investors often walk into the stock market trying to dodge the transaction. They want the returns, but they try to find a way to avoid the hidden costs attached to them. You see this play out the moment a portfolio's value drops by 20% in a single week. The immediate reaction is sheer panic. Investors often view a 20% drop as a penalty for a bad decision. In reality, it's the mandatory cost of admission for long-term gains. Treat market volatility as a fee. High returns are purchased strictly with emotional endurance. Consider the ultimate investor fantasy, putting a massive chunk of your net worth into Netflix and riding it to a fortune today. That wealth came with a massive historical invoice. Back in 2011, the company faced a catastrophic reality check. This chart shows the 2011 Netflix crash. As millions canceled, the stock plummeted 80% from its peak. Look at the depth of that valley. Imagine sitting at the dinner table explaining that 80% of your future just vanished. Surviving that 80% plunge was the literal, non-negotiable price for the massive gains Netflix generated in the years that followed. You might think you can bypass this toll by playing it safe with a broad, diversified S&P 500 index fund. This area chart tracks the S&P 500 since 1980. We've highlighted every major downturn zone in red. Since 1980, the market spent 13 combined years sitting 20. Early humans who treated sudden threats as more urgent than opportunities were the ones who survived to pass on their genes. This is intensified by the speed of events. Progress happens painfully slowly, while setbacks happen overnight, instantly triggering our ancient survival instincts. Your brain is hardwired to perceive a routine market drop as a mortal threat. It takes a mathematical fee and makes it feel like a matter of life and death. Urgent. It's tempting to try and dodge this pain by predicting the next black swan crash, but jumping out of the market out of fear almost always results in missing the explosive, unpredictable days of recovery. The math is unforgiving. If you invested 20 years ago but missed just the 4 best performing days in the market, your overall return would be cut nearly in half. Try a different perspective the next time the market bleeds. Those red numbers on your screen are simply the invoice for a brighter future. Financial success comes down to a behavioral test. Whether you have the stomach to swipe your emotional credit card and pay the fee of volatility.